Houston. Welcome once again to On the Money with Ryan Wheelis and Matt Stevenson. I'm your host, Spike Spangle. Ryan, how are you doing this week, my friend?
I'm doing great. Ready to bring the thunder for the great audience of Houston today and talk about some really interesting things. There's a lot going on with markets today, a lot going on with the economy and inflation and all this talk. And so, we do this show for the folks at Houston to help you live the best life you possibly can with the resources that you have to work with in your golden years, so you can enjoy all that you've worked for your whole life. And that's what the show is all about.
Right. The founder of Allied Wealth, and today with us, the president of Allied Wealth, better known as Blade Stevenson, inside the office. How are you doing,
Indeed.
Matt?
Great to be here, Spike, and I'm going to try to keep up with this guy here on the show today.
You've been keeping up with me for a long time. You folks at home, you may not know, Matt's been with the company for 12 years, started out at the front desk, and now serves my right hand as president, and is just an absolute blessing and powerhouse with the firm. So helps a lot of people in a lot of ways.
Well, and I get to spend a lot of time with you guys, at least in my headsets. We also do the weekly radio show together, and I know something that we've been talking about, getting a lot of calls about, obviously the market volatility and everything that's going on right now. And I don't care if I'm sitting at a bar or sitting at a barbecue. One of the first questions that somebody asked me is, should I move to cash right now? Should I get out of this risky market? What do you guys think?
Yeah, and that's one of the main questions that we're getting from our own client base, Spike. And, it's a difficult situation, not only for the stock market, but this is one of those rare years where both the stock and the bond market are down at the same time, and quite substantially in the middle of the year. So it's difficult to know where to turn and what to do in building a plan moving forward.
It is. And so a lot of people don't understand that's what's happened this year, is that the market and the stock market and the bond market have actually become correlated. And so what we depend on usually is something called diversification to help guide or guard us from down markets. And what that means is, if the bond market's falling, the stock market's usually going up. If the stock market's falling, the bond market's usually going up. So you've got offsetting attributes inside of your portfolio allocation to kind of offset each other, with a goal of rebalancing once a month and producing a 1% per month return, and life being happily ever after. And what's happened here this year is both the bond market, down about 13.5% this year, and the stock market, down about 20% this year, have correlated, and they've both gone down. And guess what, folks? If the Federal Reserve Bank keeps raising interest rates to fight inflation, it's only going to get worse. So it's a very, very interesting and tumultuous time. And to that end, a lot of these folks, they don't realize how much risk they're taking. And they don't realize the risk until they open the statement in the mail, and they see they're down 20%. And it suddenly dawns on them, oh my gosh, I just took a 20% haircut. What am I going to do?
Well, let's talk about this glaring risk, though, of going over to cash. We might think that we're being safe by getting out of these risky markets. As Ryan is saying, though, the stock market has been down. The bond market has had its worst start in over 40 years. What are the risks of moving over to cash right now, especially if you've already taken a 20% loss?
Yeah, and I understand the psychology of wanting to move to cash with everything going haywire around us. But the simple fact of the matter is that leads to what we call market timing. When we're looking to sell all of our nest egg to cash, really what we're asking ourselves is, how and when do I actually get back into the markets? And no one in history, I don't care if you're Warren Buffett or Ray Dalio, has been proven to be successful as far as market timing to get back in.
So you're saying you can't time the markets?
That's exactly what I'm saying.
And that is, in essence, what folks are doing. If they're at home going, get me out of the market, I'll get back in later, I always ask, well, when is that later? What is your methodology and process for getting back in? And so the whole strategy is that a lot of people have portfolios that are outdated for today's times. And when your asset classes are stocks and bonds, that's what makes up your portfolio, and they become correlated, you're going to lose money, folks, if both of those asset classes fall. So what we like to do at Allied Wealth is help our clients learn about the different ways of investing. And those ways are passive investing, they're active investing, and there's what we love and do well at Allied Wealth called tactical investing, that allows you to open up more asset classes, like, for instance, commodities this year are doing very, very well. Real estate is doing reasonably well, all right? And so those asset classes, it's starting to do well after it went down. But if you can allocate to those asset classes, you may be able to get some growth there instead of being in a traditional stock and bond portfolio.
Let me ask you one in particular. Real estate, besides having $500,000 or $1 million to go buy an investment property, can I invest in real estate, outside of buying a property?
Absolutely. You can invest in real estate indexes via ETFs, which we use in our portfolios. You can buy real estate investment trust stocks. There's all kind of things you can do as far as that goes. You don't have to actually go out and buy a piece of property to invest that way. And a lot of people at home don't know that, Spike. It's a great question.
Right. From there, we know how the gas and oil companies have been doing right here in Texas. That's been good. I'm cautious to ask you these questions, though, because we don't know where real estate's going to go by next year. Interest rates keep rising. I think we would all agree that real estate is maybe cooled from last year. It was probably the #1 sector last year, going up nearly 25%.
Certainly.
But with energy, with real estate, and these alternatives, do you even have a crystal ball of where they're going to go next year?
We don't, but we don't need one, right? And here's why. We rely on mathematics, all right, folks? So when we run our tactical strategy at Allied Wealth, it's not Matt and I going, hey, we've got a dartboard here. Let's throw the dartboard at the mutual fund ticker symbols and pick one. We take a mathematical approach that has the ability to gain about 70 to 80% of the asset class upside. Now, when I say asset class, I don't just mean the stock market. I mean the bond market. I mean the real estate market. I mean the international equity space, and I also mean the emerging market space as well. And so our mathematical approach allows us to capitalize on 70 to 80% of the upside and help mitigate the downside risk in a portfolio just somewhere around 30 or 40%. And the reason why we do it this way, folks, is this. I can rely on mathematics because 1 + 1 will always equal 2, 2 + 2, 4, 4 + 4, 8, and so on down the line. And for that reason, folks, our tactical core model portfolios this year have done a phenomenal job at mitigating downside risk, and they work very, very well.
Right. Okay, Matt, we're going to be doing today and through the next coming weeks, because of the volatility that's going on, and we're doing it on the radio show as well. If you call in here, we're going to be doing a portfolio x-ray. We're doing that complimentary. So not just for your own clients, obviously you're watching those, but for the folks here of Houston, the folks here in Texas, you're willing to do a portfolio x-ray. What things are you going to be taking a look at?
Absolutely, Spike. So we want to give you a second opinion and more insight into the things that you're already doing. You know, we're seeing these questions as well from the people calling in from the show, listening on the radio. Is it time to sell to cash? Is it time to reallocate to other investments? Do I need to be in the market at all? If you have these questions, give us a call. It's 844-944-7555. We're going to look at your current investments, see if there might be some tweaks or adjustments to make, and apply some concepts that you might not already have inside of your nest egg.
When we get back from this break, we're going to talk about some of the technical research that goes behind doing a tactical management style like this. We're going to go into dollar bar, some other things that Matt is going to explain for us very, very well. But folks, call and get your own complimentary portfolio x-ray. We're going to take a look at your risk, your fees. Is this appropriate for you? Are you being passively managed right now? Are you not hearing from your advisor? Then call this phone number right now, 844-944-7555. More On the Money with Ryan Wheelis and Matt Stevenson when we get back right after this.
How confident are you in your current financial plan? Do you know with certainty how the recent market volatility will affect your future hopes and dreams? How much are you paying in taxes? And how much are you losing to unnecessary high fees? You didn't work to save this money so that you could spend your time worried in retirement. Now is the time to take charge of your finances so you can feel confident about your future. Call in during the next 30 minutes of today's show only to set up an absolutely complimentary, no obligation, full-blown financial review that will result in your own customized written plan that we're giving away complimentary to the first 10 people who respond. We'll start with a full-blown analysis of what you already have. By running a report to untangle how much you are currently paying in fees, how you're allocated for risk, and what it's costing to work with your current advisor. Next, we'll identify your goals. Where do you see yourself in the next 5 years? Where do you want to go, and who do you hope to go there with? Is your current financial plan set up to get you there without mishap? Let's design a roadmap to create a financial plan you can follow with confidence. Get the piece that so many people are missing from their retirement. Find out how having a written plan can make a difference to your retirement dreams. Call now to schedule your complimentary, no obligation, full-blown financial review today.
Welcome back to On the Money with Ryan Wheelis and Matt Stevenson. I'm your host, Spike Spangle. We're talking about your retirement planning strategies, especially in today's volatility and what's going on. Right before the break, we're talking about management styles. Passive, I think, is what happens in most people's retirement accounts at work, that 401k. We put money in, we make the elections, we cross our finger and hope for the best. So there's a passive side. There's active, maybe more brokers and stockbrokers, people trying to tell you what to buy and sell, to take advantage of the ups and downs. But then there's another version of it, what you call tactical. Can you guys tell me a little bit about the research behind it and why you're such a big fan of implementing this?
Well, we've been doing tactical management live in our portfolios at Ally Wealth since 2018, and we have had tremendous results. And for instance, a great example is taking a mathematical approach in 2020 when the stock market was down 35% on March 23rd during the COVID crash. Our portfolios were down a fraction of that, all right? And then to that end, we were able to finish the year ahead of the stock market in our balanced portfolio on up to aggressive portfolio. And that's pretty awesome. I hear people hear me say that, like, Ryan, that's really good. And so the way that's done, folks, is we take a quantitative mathematical approach to evaluating the right asset classes to be in the right times, and also evaluating the wrong asset classes to be at those times, and moving money away from those overvalued asset classes at those times into positions of strength in the asset classes that should be going up. We also have the ability to allocate to very short-term treasury bonds, which are cash and cash equivalents, until the market kind of cools off. But here's the problem. I would love to tell you that we were conservative and in a really fallback position on March 23rd, right? But then we just nailed it perfectly. The bottom hit, right? And we just jumped right back in the markets and started going up the other way. It doesn't work that way. It took us a while for our models to find their footing through mathematics and kind of find their way. Hey, the market's actually going back up. It's time to start slowly allocating capital back into the markets and going higher, right? But so the cool thing about that, folks, is that at that time, people were very concerned. They were watching the news. They weren't really connected to their money and logging to their accounts because, we were going through a pandemic. We'd never been anything like that at that magnitude before as a nation and a people. And what was happening is people were looking at their accounts going, wait a minute, they're looking at the news, not looking at their accounts, and they're thinking to themselves, I got to be down on this money. Well, the reality was they weren't. And when people saw that, they're like, wow, this is actually pretty cool how this stuff works. And so it's uniquely different. An active management system usually beats its benchmark about 20% of the time, which means it loses to its benchmark about 80% of the time, right?
Yeah.
So we're always like, okay, we're trying to find the best things to put our clients' money in. Why on earth would I want to use something that loses at 80% of the time to allocate capital to? And that's why we design our tactical strategies.
And, Ryan, to me, when I talk with our clients every single day, the thing that using a rules-based approach does the most for them, it gives them that confidence back. When we're in an environment like we're seeing right now, is exactly when you lose confidence in what you're doing. But that's why we're here, to give you that insight and that second opinion, and most importantly, take that emotional decision-making off the table as much as we can to have a systematic process to abide by.
Why would we want to remove emotions from this, Matt?
Yeah, because that's when your emotions play tricks on you in an environment just like this. The market's down 15, 20% this year. And, we talked about going to cash earlier in the show. We never know what's going to happen. We don't have that crystal ball.
Right, but people usually react to one of two emotions when it comes to their fear.
That's it.
Or greed.
Fear,
exactly. Right? Which way are we going? We're excited about what's going to happen. And I understand the reacting to the fear right now, but one of the things that you guys had shared with me with this Dalbar study is when most people invest on their own, they hardly receive maybe 50% of the actual gains that are in the market. And I think that's because they are reacting emotionally to what's going on as opposed to mathematically.
That's exactly right. And of those two emotions, fear is always going to be the stronger reaction when we're seeing that drawdown or loss in the market. So you mentioned the Dalbar study. Dalbar has released a investor behavior study every year for about 2 decades now. And every single year, what they find is quite shocking. No matter whether it's a good, bad, or ugly market environment, the average investor gets about half of whatever the market does in that given year.
And now why is that? Because they're choosing to buy and sell based on their emotions of what's going on, or they don't stay in long enough, or?
It's choosing to act on emotion, which is the worst possible time to make investment decisions. It's looking at political fears. Hey, I think Trump's going to lose or Biden's going to win. You know, I'm going to stay out of the market. And, right. So there's all these biases that come into play, all of which ultimately lead to bad decisions. And that's not me telling you that. That's not Matt or Spike telling you that, folks. There's a study that's been around for over 22 years that tells you that, and it's never changed. It's the same results every single year. So to that end, it's one of those things where you've got to get away from the emotion to allow you to drive your investment decisions, because what will happen is if the market falls, this happened to a client of ours, by the way, in 2020, okay? He had a lot of Exxon stock, and he called me at the absolute low of Exxon stock in the COVID crash and told me I got to get out now. Now, he didn't want to sell his Exxon stock when it was at $75 a share, but it was down to like $32 a share. He wanted to sell it. And I'm like, you can't do this. You absolutely positively can't do this. You're making this decision based on emotion. You don't do this, please. And to cover us, I made him actually send me an email with the instructions of what he wanted to do. And it's his money. I had to execute the trade on his behalf, and we did. And guess what? Exxon stock recently crossed $100 a share.
Yeah.
You know, and that guy to this day, he won't talk to me. And he won't talk to me because he knows he made a terrible decision based on emotions, folks. And that's why when we do what we do at Allied Wealth, we take a rules-based approach, and that rules-based approach is designed to help you not make bad decisions when it comes to investments, because we have a plan when this happens. We have a plan when that happens, and our plan is mathematics. And you can rely on mathematics because, again, 1 + 1 will always equal 2, 2 + 2, 4, 4 + 4, 8, and so on down the line.
Exactly. And going back to the confidence factor of building a plan, when we see this market environment, especially for people that may be going into retirement or getting in that retirement red zone 4 or 5 years out, you start to question, well, do I need to work an extra year or two? Do I need to shift my mindset? Can I even afford to withdraw from my nest egg at all? And again, that's what we're here to help you with, folks, is to instill that confidence that you can lean on your nest egg for the next 20 to 30 years, if not more, without a paycheck and not run out of money in the process.
And here's the thing, folks. If your portfolio is down 20% this year, think about this for a second. Are you working with an advisor right now? Are you paying advisor fees? Does it make sense you're paying advisor fees and working with this advisor, yet your portfolio is down as much or more than the market is? So it's a great question, right? And so oftentimes we see that folks are working with advisors who don't move things around, that they think they do, but the advisor's not doing that because that's not their business model. A lot of these folks that sit behind these desks in these retail buildings and strip centers and banks, you think they're financial advisors, and they really aren't. They're product salespeople, and their motive is to sell people financial products and annuities products for commissions. They're not there to actually manage your capital. What they do is they farm that money out to a mutual fund manager or a separate account manager, and that manager is the one that runs your capital, but they have constraints as well. And oftentimes they can't move you to cash inside those mutual funds. They're constrained by the naming rule, according to the SEC. So when we designed our systems at Allied Wealth, we wanted to remove all those things and have the client have the ability to have the best chance at long-term success. And we offer a portfolio expert on the show. And I got news for you, folks. If you're down as much as you are right now, as much as the markets are, you should have known that portfolio that you're in could behave like that in a down market. You should have known that going into it. And shame on your advisor for not showing you that. But remember, why would he or she do that? They're salespeople. So, folks, please take advantage of the Portfolio X-Ray. It's so easy to get. The number is 844-944-7555. Use the QR code, register there. Call us at 844-944-7555. A deep dive into your fees, a deep dive into how your portfolio behaves in market crashes, which are destined to come in the future.
What can you do if your portfolio has taken a 20 to 25% hit? We're going to tell you exactly what you should be doing when we get back after this break. Please take advantage of the complimentary offer. Call that phone number right now, 844-944-7555. More with the founder of Allied Wealth, Ryan Wheelis, and the president of Allied Wealth, Matt Stevenson, when we get back right after this.
As a good saver, you've been putting away money during your working years. Studies find that the biggest fear of retirees is running out of money. Market volatility isn't just the downward movement of stock prices, it's the size and frequency of change. The more dramatic the ups and downs, the higher the volatility. This can put savers who are newly retired or a few years away from being retired at greater risk. Today's generation of retirees is not receiving traditional pensions as our parents or grandparents did. Instead, we have retirement accounts such as 401ks or 403bs. These accounts typically expose your money to market risk. The last thing you want right before retirement is to lose a portion of the money you need for income. But how do you turn these accounts into a retirement income? Is it safe to keep all your retirement money sitting in the stock market? The last thing you want is to lose a portion of the money you need for income due to market loss. By working with a financial professional, you can learn how to turn a portion of your savings into an income stream for life and income for the life of your spouse if you're married. We all have moments in our lives when we wish we had taken action sooner. Don't let procrastination reign on your retirement parade. Act now before it's too late. Please call our office to set up your no-cost, no-obligation retirement income review today.
Welcome back to On the Money with Ryan, Matt. I'm your host, Spike, and we're talking about solutions right now for that 20% drop that a lot of folks have seen in the market. Well, let's be honest, though. If this has happened inside our retirement accounts at work, is there anything we can do with those right now?
There's no question you can do something about it. Now, it may come with some pain, all right? So if you were a year out from retirement, you may delay retirement for a while. If you're someone younger than that, what you should be doing is saying, hey, you know what? This is actually an opportunity for me to be adding money into my 401k. I'm using these new dollars to buy in at a lower price point. So I'm actually dollar cost averaging into the markets. That's actually a very good thing for somebody 50, 55. Someone on the cusp of retirement, you may have to push retirement out for a while. It is what it is, okay? But what can you do as far as allocation goes? Well, folks, we are in an inflationary environment right now. The market volatility, the downside we're experiencing right now is a direct result of supply chain issues and inflation and things getting out of control cost-wise, and the Federal Reserve Bank trying to fight that inflation by raising rates. So there are asset classes that actually do reasonably well in a rising rate environment. So what I would do is dive into my 401k plan, look at all my funds, do some research, and find out which ones can allocate towards commodities. All right. Which ones can allocate maybe towards gold or silver if possible, and also real estate. Some of them have indexes will have larger real estate exposure in there as well. And lastly, you can look at Treasury inflation protected securities if that's an option in your 401k plan. Some of the bond funds have those mixed in there. Okay. And you can also look at real estate funds inside of your 401k plan. Those are some avenues you can allocate capital to likely recover faster because they do better than other asset classes in a inflationary environment.
I think Matt wanted to raise his hand here.
Yeah, guys, that's so important because what folks may not realize is a lot of people invest into those target date funds in a 401k, right?
Let's go over the target dates. Yeah.
You know what those are? It's a mixture of stocks and bonds. So as you get closer to that target retirement date, that fund is naturally going to become more and more conservative or add more to that bond portion of that fund. And in a rising rate environment such as we're in right now, that may not be the best place for you to be. So as Ryan was saying, let's look inside the 401k at your alternatives. Let's see if there's some other categories of assets that we can take advantage of. And as part of the portfolio x-ray, we're also going to look and see if you're at 59 and a half or older, you may have the opportunity to do what's called an in-service rollover, to where you have a whole universe of options at your disposal.
Well, in an in-service rollover, Matt, we actually have the ability to build what we call an accelerated asset recovery plan. So you can roll your money out of your 401k over to an IRA. That's a non-taxable event. Your 401k plan still stays intact at work. Your contributions are still matched. You can still put dollars in there, no problem, right? So nothing changes there. But we have the ability to allocate your capital to products that actually give bonuses. So we have products that give a 5 or 7% bonus up front day one to them, right? They have no downside risk. You can get upside potential in the markets, but you don't have any downside risk, right? And so that's just one avenue. And the reason why I mentioned that, folks, is that we all think that our risk tolerance is high when the stock market's going up. When we're getting close to retirement, starting to depend on those dollars that we save to fund our lifestyle in retirement, what happens when the market starts falling? We realize real fast, our risk tolerance is not near what we thought it was, okay? So what we may look at doing is, all right, let's look at it, take a different approach. Let's take a balanced approach between risk portfolio and safe portfolio. All right, split your money in those two buckets, okay? And on the safe portfolio, let's see if we can go shop for a program that gives you a 5 or 7% bonus up front day one to kind of help you recover. And then on the risk portfolio, allocate that capital towards those asset classes that do better in an inflationary environment. And that's just a high-level asset recovery plan right there. I just gave you for free on television.
And how many times, though, do you see somebody who comes in and they're 60, 62 years old and they're still invested like a 35-year-old, that they haven't realized or changed their allocation in their retirement accounts?
All the time, Spike. And that's really one of the main elements that we're going to look at. You know, we talk and you hear that old adage of risk tolerance. You know, what are you comfortable with as far as taking risk in the market? To us, what's more important is what is your capacity to actually take risk when you're in that retirement red zone, or maybe you're freshly into retirement. You may not be able to afford the same level of risk as you were taking all those working years now that you need to start generating that reliable source of income from the nest egg. So that's all part of the portfolio x-ray we're going to do with you.
And something I do want to be clear on. President of Allied Wealth, you're the founder of Allied Wealth. You're not just talking about the tactical and the management strategies. You do work with clients on a daily basis, right? You are still talking to folks on the front lines and helping them with their retirement strategies?
Absolutely.
Absolutely.
We help with our clients every single day, and that's what we're here to do, is help them.
Yeah, we have a large bench as well. We've got 8 financial advisors in the office, a full service team. So we're
yeah, I noticed Peter's not here today. What do we do with
Pete's
Peter?
on vacation, which is pretty constant with Peter, but he's on vacation, right? Well-deserved vacation to his credit. So, folks, listen. If any of what we're saying today is resonating with you, and you want us to build a portfolio X-ray for you and help you establish your very own asset recovery plan, pick up the phone and call us. The number is 844-944-7555. Again, 844-944-7555. You can also use the QR code on the screen. Click that QR code. That'll take you to a registration page. Fill out the information, and Matt or Peter will give you a shout back. Find out what you're trying to accomplish and see if we can help you. And folks, listen, I can tell you right now that a lot of us at home we're worried, we're concerned, we've got fears, and we've lost our confidence, and we think we've lost our way forward and may not be able to retire. But I can tell you, this too shall pass, and it will pass in time, and you will be okay. But listen, next time, and this will happen again, let's make sure we understand the risk we're taking before we invest our money in the portfolio that we're going to go into, not after. That way, when this happens again, you know what your downside risk is. You know if your current portfolio meets that, and if you're going to be okay or not in a market crash. And that's all part of some of the things we do as part of the Portfolio X-Ray Challenge.
Ryan, Matt, thank you guys so much. We're going to keep talking about this week after week. Folks, please join us on the radio show as well. Thank you so much for watching On the Money, and call and get your own complimentary Portfolio X-Ray. Thank you so much.